Hey YouTube, Casey Dimon here, TaxSaleAcademy.com, and you are about to watch me record an episode for the Tax Sale Podcast where tax sale investing is made easy. As always, of course, if you enjoy podcasts, make sure you find us and subscribe to us. Just simply search Tax Sale Investing and you'll come across our podcast. We're available on Stitcher, iTunes, Google Podcasts, really all the different podcasting platforms. We are there, so make sure you find us and subscribe. I'm going to click record and we are going to get rolling on this episode. Hey everybody, welcome to the Tax Sale Podcast, where tax sale investing is made easy. I'm of course Casey Dimon, a veteran tax sale investor, an expert and trainer, as well as the author of the Tax Sale Playbook and the founder of the Tax Sale Academy. Thank you so much for joining me on today's podcast. As always, at the conclusion of this podcast, if you're looking to learn more about investing in tax defaulted real estate, be sure to head on over to TaxSaleAcademy.com. Again, that's TaxSaleAcademy.com. We have loads and loads and loads of information and training and strategies that we have used personally over the past 15 plus years in the business, and also that our students have used successfully as well. On today's episode, we'll be discussing both tax liens and tax deeds. Now, we've already discussed the different systems and exactly what both liens and deeds are, how they operate, all that good stuff. Now, today's episode, we're going to be talking about them more from a tax sale investor standpoint, more from an investment standpoint, opposed to a procedural standpoint, opposed to, how it actually works, that kind of stuff. So now it's going to be looking at the angle from an investor, from their money, that kind of thing. Now, a lot of beginners, they want to know, should I invest in tax deeds or should I invest in tax liens? Which requires less money? Which has less risk? Which has bigger rewards? Which takes more work, less work, all this good stuff. All these different questions I get asked pretty frequently. So that's the reason I'm doing this podcast today. Now, what we're going to do is we're going to go over each of them and then we're going to compare the two investment vehicles. Now, before we begin, I want to make sure you pay close attention to two words, lien and deed. We're going to be saying tax lien a lot, and we'll be saying tax deed a lot. These two are not interchangeable. They're not the same thing, okay? So again, listen very closely because we're going to be using both terms. First, let's start off with tax liens. So, as we know, a tax lien is a priority lien against a parcel of real estate. So if somebody fails to pay the taxes, then they have a lien that is placed against their property. That lien is then sold to somebody known as a tax sale investor, such as you or I. The tax lien investor who purchases that lien will typically earn some sort of interest on their money, on their investment. Now, as we know from a previous episode, the return on this investment, the interest rate that is, can vary from one area to the next, and it really can even vary from one property to the next. In fact, it could even be a negative return in some rare situations. Now, in the event that the lien is not redeemed by the defaulting property owner, the tax lien holder can eventually acquire title to the property. So you're initially and you're primarily buying a lien against the property when you invest in tax liens. So that's the quick breakdown of tax liens. Now, obviously, if you're looking to learn more about tax liens specifically, I'd highly suggest that you listen to the episode here on this channel about tax liens. Now, let's look at tax deeds. In a tax deed system, it begins the same way. They both begin the same way. You have a property owner, they fail to pay the taxes on time. But instead of a lien against that property being sold, the county will essentially hold that lien in-house. They'll still charge interest and fees, all that good stuff, but they'll collect the money instead of actually selling that lien off. Now, once the window for redemption has expired, the county then sells the actual property. So they don't sell a lien, they just sell the property in a tax deed state. Of course, in some situations, like redeemable deed states, the property owner can still cancel the deed later on, but it's important to understand that you're actually still buying the property when it comes to tax deeds and not just a lien on that property. So tax deeds, you're buying the property, tax liens, you're buying a lien. Again, if you'd like more information about the specifics of both deeds and liens, be sure to look up those individual episodes on this channel because what I've just gone over is just a brief overview, okay? Now, so let's talk about it more of a investment standpoint now. We got all the procedures that are rehashed, all that good stuff. Let's talk about the investment type standpoint. How are you going to make money, right? So a tax lien is a lien. You're buying a lien against the property. You're buying that lien against the property to earn interest. A tax deed is the actual property. You're buying a tax deed because you want to buy the property and you want to usually sell that property. But what's your investment secured by, right? It doesn't matter if you're buying a lien or if you're buying the property. they both boil down to the underlying real estate. The underlying asset that your investment is secured by is that real estate. So whether you buy a tax lien or a tax deed, it doesn't matter. You must ensure that the underlying asset, that's either the real estate that you're buying or the real estate that is secured by the lien you're buying, is going to be worth your investment at the very least. And hopefully, of course, a lot more. I mean, you don't want to buy a tax lien for $1,000 and the property's worth $1,000. By the time you get done foreclosing, all that good stuff, you made zero money or negative money. So obviously, you want the underlying real estate to be valued much higher than your lien or the deed that you're buying. So your first priority, when you're talking liens or deeds, does not matter. Your first priority will always be the underlying real estate. It has to be the underlying real estate. That should be your number one priority. You just don't go out and buy a lien at $100,000 because it has an 18% interest. Because the deal is, if the underlying real estate is absolute junk and they don't claim that lien, if they don't redeem that lien, you lost that money. So your number one interest, your first priority, will always, always, always be the underlying real estate. Now, if you buy a deed to the piece of property, on the same token, if you pay $100,000 to buy the deed to the property, where you actually buy the property, but that property is still garbage, guess what? That's still a bad investment. So again, folks, I'm just trying to drive home the point that your priority's got to be the underlying real estate, okay? Now, that also goes to say that it doesn't matter if you're purchasing a lien or a deed, the investment that you make, the time investment that you make researching that property must just about be the same, right? You have to fully understand that property. You have to fully understand the value of that property, what's going on with that property, any issues with that property, because ultimately, that's what your investment relies on, so you have to understand what's going on. So again, tax liens, tax deeds, they both rely on the underlying asset, which is real estate, and the underlying asset, the value of that asset to you as an investor, that is reliant upon your research on that property. So when you buy a lien or a deed, you have to know that property inside and out. Okay, let's move on now. Let's talk about how you'll be making money off both deeds and liens. So as a tax lien investor, you'll be earning interest on your money, maybe interest, fees, that kind of stuff, but you'll get interest and fees back 95% of the time. You will not make your money by selling the property 95% of the time. The other 5% of the time, this is statistics now, this is not me just making numbers about thin air, but the other 5% of the time, you will actually be able to take title to that property. So what I'm trying to say here is 95% of the time, your lien will be redeemed, you'll earn interest or fees on your investment. That other 5%, the defaulting property owner will not redeem that property, which means you'll have to take title and you'll have to sell that property. Now, a lot of beginners, they kind of look at tax liens as like a workaround to acquire title of the property. Hey, I'll just pay 1 year's taxes, or I'll get it very, very cheap because I'll buy the lien. They don't pay the taxes, and then I'll become the owner of the property after a couple years, right? That's what a lot of people think when they get into the business right away. But again, look at those stats. Only 5% of the properties make it to this point, and I promise you, of the 5% that make it to this point where you can actually be foreclosed on, guess what? A large percentage are going to be junk property. So 95% of the time, they're redeemed, you make interest. Other 5%, you actually get a hold of the property and you sell the property. Now, as a tax deed buyer, you're actually buying the property, right? So you'll be earning your profits when you sell or otherwise use that property. You could rent it, could subdivide it, whatever you have to do. But however you sell that property, disperse the property, however you utilize that property, that's how you're making your money back. So you have to buy it, then you have to sell it, or otherwise make some sort of money off of it, right? You gotta rent it, that kind of thing. So you're buying a property, and then you have to do something in order to realize your return on that investment. Does that make sense, guys? Okay. So as a tax lien buyer, you won't typically be required to go through the time and the expense of having to sell the property in order to realize a return on your investment. Like it or not, it does require time and it does require effort in order to sell a parcel of real estate. So when you buy a tax deed property, you have to put forth the time and the effort and sometimes even the money to sell that real estate. As a lien buyer, you want to invest this time. You want to invest this effort at least 95% of the time you won't, right? Now, another thing to discuss is the competition. Generally speaking, there are more liens available than there are tax deeds. So it's kind of like a supply and demand type thing. And the reason that there's more liens than deeds available is typically most liens are going to be sold just a month or 2 months after the property owner becomes delinquent. So, in the state of Florida, for example, property taxes become delinquent in April. So by June, they're auctioning off the tax liens. So it's a fairly quick time. They don't have a whole lot of time to cancel sell the lien, all that good stuff, right? So it's fairly quickly. Now, obviously, once the lien is sold, they still have time to cancel after that point. What I'm trying to say, though, is the liens are sold very quickly after the property becomes delinquent, okay? Whereas a deed, the tax deeds are sold at least a year, more often 2 or 3 years after that same owner has become delinquent. So there's certainly going to be a lot more liens to choose from. Now, you might even have the same amount of interested investors. You might have 100 tax deed investors, 100 tax lien investors, whatever it may be. But just because the supply is much, much greater, overall competition might be less. With that said, the competition you do have can be very, very stiff. It might even be 1 or 2 parties that seem to dominate the tax lien sales in your areas. In fact, you might be even bidding against banks or other large corporations when it comes to liens. There are lots of banks, insurance companies, and other corporations that utilize tax liens as an investment vehicle since it is safe and provides favorable returns. There's not a whole lot of people in the general public that really understand or even know this. But I promise you, I've been to large tax lien auctions before, and I'll see bankers walk in, and I'll ask them, I'll just get in conversations with them, and they'll tell the name of your bank, and it'll be one of the largest banks in the world, or it might be a large insurance company, or something along those lines, large investment companies. You're thinking, wow, that's like a Fortune 50 company, right? They're actually buying tax liens because they work, right? So don't be surprised if sometimes you come across these folks at the tax lien sales. Now, these same companies usually will not bid, however, at tax deed sales. This is because, of course, as we've discussed, tax deeds do take additional effort in order to realize your profit, to realize your investment. You must actually sell that property. Whereas banks like liens, since they can typically just sit back and collect a check from the county for their interest. Now, let's talk about returns. Typically, what you'll find is that the amount of work up front is always going to be the same, or it should at least always be the same. The underlying asset is real estate, as we've discussed. The underlying value to that asset is going to be determined by the research you did on that asset. Whether your research was good or bad, that's going to determine how your investment is. So again, you must make sure the value is there. So the work up front is going to be the same. When you invest in liens, however, you are typically going to receive interest on your money, as we've discussed. This might translate anywhere from 5% to 50% per year, right? When you invest in deeds, your returns will be based on what you can resell the property for, minus all your expenses. What I usually find is that when your investment expectations are met, when everything is met, nothing crazy high, nothing crazy low, but about average, when they meet your expectations, when you invest in tax liens, you're typically going to make much less money, but you're also typically going to be required to do much, much less work. When you invest in deeds, you're going to make much more money, but it'll also require much more work. So again, liens usually mean less work and lower returns. Deeds typically mean more work and higher returns. We also know that based on the stats, 95% of liens are redeemed, which means that 95% of the time you're going to get at least your investment back and possibly much more. Now, obviously, if you didn't do it as far as the industry standards go, if you made some crazy investments, that kind of stuff, the numbers can be skewed, but we at least know that 95% of the time when the liens are redeemed, you're going to get your money back, right? When it comes to deeds and you have the actual property you have to deal with, there's lots of other factors involved. Market conditions, property conditions, house could burn down, it could take you a long time to sell it, you can have all sorts of expenses, HOA dues, all that good stuff. So there are more things, more hurdles to pass, to cross over whenever you're investing in deeds. So which one should you invest in? Should you invest in liens or should you invest in deeds? Well, the truth is, when I was much younger, I actually hated tax liens. I didn't care for it. I was 100% tax deed investor. I just didn't like tax liens. The truth was, when it came to tax deeds, I felt that I could make much more money, so that's what I went for. But as I became older, and I guess you could say wiser, I realized that tax liens are a very viable solution for many, many investors. First off, they do require much less work than tax deeds. They can be a truly passive investment vehicle once that initial research is performed. Secondly, it's better than the alternatives. Unlike stocks or anything else like that, the investment is actually backed by real estate, which of course I love. And I usually find that the investors who are looking for solid, steady, reliable returns without a whole lot of effort, besides that initial research, invest in tax liens. And they do very well. When it comes to tax deeds, You can certainly make more money faster, but it does require more effort and more work, as we discussed. Not only have to research the property like you do a tax lien, but you also have to go through the time, expense, and effort to maintain and sell that property. And of course, the rewards are much bigger. Okay, I have students that invest solely in liens and solely in tax deeds. Some love liens, some love deeds. My preference, however, is that depending on your specific situation, that you invest in both deeds and liens. If you're younger, you have more time and a higher risk tolerance financially, then perhaps you should invest maybe 80% in deeds and 20% in liens. If you're older, working full-time, maybe you have a low risk tolerance, perhaps you invest 20% in deeds and 80% in liens. Now, the percentages are going to fall in a variety of different numbers depending on your comfort level. So if you're a tax deed buyer, don't be afraid to invest in liens. And if you're a tax lien buyer, don't be afraid to invest in tax deeds. Both liens and deeds are very, very viable, sustainable investment opportunities. So there you have it. Tax liens versus tax deeds. That's it for this episode, guys. I really hope you've enjoyed it. As always, for more information, head on over to taxsaleacademy.com. While you're on the website, be sure to snag your free copy of my brand new book, Tax Sale Playbook. Just let me know where to ship it, and we're going to get it out to mail to you. I'd also like to ask you a favor, guys. This podcast is completely free. And the truth is, I absolutely love talking tax sales, and I love providing strategic and actionable training and strategies for you guys. But I'd like to ask you one favor. If you can go ahead and just rate this podcast for me, it'd really help me out. I would certainly appreciate it, and it would definitely help to continue to motivate me to continue to do lots and lots of podcasts for you in the days moving forward. That's it for today, guys. As always, hope you have a wonderful day, and I wish you lots of success in your tax sale investing business. Take care, guys. Bye-bye.